what troubles me is the complacency of those at the top and their general lack of appreciation for the malaise at the bottom. They believe that no matter what the outcome, they can leave, they can migrate to wherever they want to, that the crowd will allow them to exit gracefully. And history doesn't suggest that. And I think there is nothing like shared hopelessness to motivate a rapidly moving crowd.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. There's an old saying in investing: the market can stay irrational longer than you can remain solvent. Why is that? Well, it has a lot to do with how humans make decisions. It's not always, or even often, rational. And today's expert, behavioral economist Peter Atwater, adjunct professor at William and Mary College, has long affirmed that changes in confidence consistently and predictably impact investor preferences, decisions, and actions. He's out with a brand new book, The Confidence Map, charting a path from chaos to clarity that shares a groundbreaking framework for making better decisions in investing and in life in general by understanding and mastering confidence. We'll also ask him what his key confidence indicators are telling him about the prospects for the rest of 2023. Peter, thank you so much for joining us today.
Great to be here, Adam. Thank you.
Oh, well, look, Peter, thank you for coming back on. Always a pleasure to have you. You're out with a new book, no less. Can't wait to dig up our sleeves and dive into that. Very quickly before we do, if we can just kick off with the general level-setting question I like to ask all my guests at the beginning of these interviews. What's your current assessment of the global economy and financial markets?
So I spend less time worried about the economy than I do the markets. So I'm going to skip the first part of your question, but talk about the second part. I think we're at a real inflection point. This is August 8th, and I'm troubled by a couple of things. I'm troubled by the nature of this advance since last October, because it's so different from what we saw 2 years ago. 2 years ago, if I rewind the tape, investors were buying wildly abstract companies that were brand new, if at all formed, SPACs, NFTs, crypto, all of that. This has been a bull run in the stalwarts, the stallions, as it were, of these magnificent seven, these really big, the biggest of the big, the tried and true. And that to me says we're not as confident as we were 2 years ago behind the scenes, and yet it's being masked in the indices because of the overweights that these seven names have in the broader measures. So that bothers me because, if a small handful of companies can propel the market higher, they can also drag it lower. The other piece of it that is fascinating to me is the speed at which changes in sentiment are now manifesting in dramatic market moves. And we saw a glimmer of this in 2021 with the meme stocks. We saw a second peak of this when Silicon Valley Bank and Signature collapsed. We de-deposited financial institutions in matters of moments. And, the meme stock group is back, but I think it's better to say, I think the term is a hyper mobilized group, thanks to social media. And I think that if we see sentiment change, that impulsivity and that emotion could be very high, because we've got all of the makings of a panic, given the speed at which we can take emotion and move it into action.
Really interesting. So is this sort of accelerated speed in how sentiment can shift Is that new, and do you mostly attribute it to social media, or is it due to other factors as well? Maybe like algos and other things that are happening at faster speeds than did in previous investing generations?
So I think it's a combination of those two, but definitely the communication technology. Um, I became a real financial crisis nerd during the 2008 banking collapse. And I remember reading about the Panic of 1857, which you would say, so what? But it was different from all the prior panics because of its speed. Where prior panics took weeks, if not months, this one took days, maybe weeks. And the difference was the telegraph. Prior to that, everything moved by mail. And so if you step back and go, telegraph, telephone, radio, television, the internet, and now social media, we've created means by which we can assemble bigger crowds faster. And now we've equipped them with tools to trade with that, all the online banking, the online trading. And I think the algorithmic trading helps to exaggerate these patterns because they're looking at patterns and love nothing more than to jump in them and extrapolate them. And so that combination is something that I don't think we're quite prepared for in a down market. We all giggle when Tupperware or choose the stock goes sky high, but I think we need to be prepared for the consequences to the downside, particularly because investors in these groups are not necessarily bullish or bearish. There's a nihilism and an agnosticism to them that they're happy to make money up or down.
All right. So it's super interesting. The visual I have in my head, correct me if this is good or bad, is, maybe where past market cycles, the herd changed sentiment, not unlike maybe a herd of bison, right? That would go across the plain, and then if the lead bison decided he wanted to go in a different direction, that herd would sort of slowly turn and go in the new direction. Now it's much more like a murmuration of starlings, or like a school of fish, where they can just very quickly, the entire group can just move on a dime, if you will.
Yes, that's exactly the image difference. Okay.
All right. So we combine that, maybe we'll say sort of increased volatility of confidence and sentiment with, that was a really interesting observation you made. I hadn't really thought of it this way. The markets have, powered higher a lot more forcibly than folks thought they would have at the end of last year, right, from the October lows. And we are seeing sort of speculations, the speculative mindset return, but it's not going crazy in terms of, flooding into the most speculative of the speculative, the SPACs, the NFTs, things like that. It's really flowing into kind of what's worked, right? These big, magnificent 7 stocks. Now, AI is new, but AI is largely in those stocks anyways. Most of those stocks are the big AI stocks. So in some ways you can say it's a sign, it's a kind of a weird word, but a sign of conservative speculation, right?
Yes.
So even though we're speculating, we're being conservative about it. And again, it's because you look at confidence, that's your primary lens, that probably is very interesting, which is we are narrowing the field that we are willing to speculate on when we're feeling optimistic now.
Yeah, we're not nearly as confident as we were, just based on the abstraction, the novelty, the creativity that we were, stampeding into 2 years ago. This is a more cautious speculation, and that says to me that investors are already on their back foot, even though it doesn't look that way when you just look at the indices.
All right, and that's interesting, and I do want to, in a bit, get you to talk about the economy in a moment, because one of the things that I find so stark right now is the difference, the disparity between the optimism that we see in the markets versus a lot of the pessimistic macro data that's out there. There just seems to be a real willful blindness, if you will, to the market, to the macro data. So, in one sense, you can say, well, the market's feeling really confident, but you're saying, yeah, but it's a certain type of confidence that's not, it's not as whatever euphoric as it was 2 years ago, if you will.
And it's not nearly as widespread.
Yeah.
So you have those at the very top who feel extraordinarily confident. And I can measure that in terms of, shares of LVMH or, the demand for Lamborghinis. But you see these pockets of absolute wildness, and then the rest of the world. And I know there's a lot of attention given to sort of the left-right divide, but the divide that worries me is the one between those at the top and those at the bottom.
At the bottom, yeah. And you're very well known for your K-shaped recovery framework, and I do actually want to get into the wealthified topic with you as well. And just to put a bow on my comment there, I do want to talk with you about the risk here that we went from everybody essentially expecting a recession to start pretty early in 2023, fears of a hard landing, to very quickly, well, maybe it's going to be a soft landing, to now it's kind of like, no landing, we dodged that bullet, right? And so I'm curious, and I'll dig into this with you a bit further, because I want to get into the kind of the core of your confidence framework, which relates to your new book. But
let's talk about this recession issue, because I think it plays to both your question and the book.
Okay, great. Then let me just spit out the rest of my sentence, then you can run with it, which is, I wonder how concerned you are that as quickly as we pivoted from, oh my God, we're surely going to have a hard landing, to, hey, only sunny skies ahead, at the next sign of something that worries us, that school of fish could change direction again, and all of a sudden it's, oh my God, we're going to a hard landing again.
Yeah, I mean, we've given up all fear of a recession, all fear of inflation. And I say that based on Google Trends searches and the fact that nobody is searching for either of those. There's been a whole slew of articles in the last week or so, Adam, on by media folks looking at who got the call wrong. Mm-hmm. So the classic head on a stick articles that I look for, where we condemn those that got the call wrong. We also deify those who got the call right. But I think the complete absolute certainty today that it's blue skies ahead is the worst indicator I know for a recession. Mm-hmm. I joke that the best leading indicator of a recession is the widespread belief that one is not possible. And I think we're there with that saturating belief today.
It's so interesting. So every week I record a weekly market recap with Lance Roberts, who's the portfolio manager at Real Investment Advice. And he was, to his credit, he was cautioning us coming into the end of 2022, saying, I agree with everybody. There's a whole preponderance of reasons to expect a recession next year, but I'm getting nervous because everybody's expecting it. And the market tends to always surprise you when everybody's on one side of the boat. Almost de facto, something else than what the majority expects is going to happen. And we've talked a lot over the past months about how, bull markets climb a wall of worry, right? And bear markets slide down a slope of hope. And when everybody was worried about the recession, that's setting up the opportunity for the bull market to surprise everybody and power, higher by climbing that wall of worry. Conversely, now that worry is gone, and we now have hopes for nothing but, as you said, blue skies ahead, that may be setting up the exact conditions for the return of the bear in the markets, and maybe to open the door for a recession.
Yeah, and remember too, at the end of last year, Elon Musk could do no right. I mean, there was this avalanche of condemning articles about him, and that to me was another sign of sort of this capitulation of pessimism. I think I called it a bubble in a bubble in bed, a bubble. I mean, it was just, there was such gloom across the board.
Which is interesting. You kind of think back to like the beginning of the 1980s, where everybody was so down on America, and we ourselves had just thought we couldn't do anything right. And then all of a sudden, we get a new president in who's mixing things up. We win the Olympics against the Russians, and then all of a sudden, it's a glory decade ahead for us, right?
Yeah.
So obviously, it sounds like you saw a parable there where everybody was just, we were tearing down the biggest of our heroes, right? Musk isn't everybody's hero, but he's sort of a paragon for American can-doism, right?
Yeah, and he's the Kevin Bacon of every major theme from this cycle, from solar to EVs to crypto to AI to space. I mean, he is at the hub of it all.
That is such a great analogy. I'm going to have to totally steal that. And again, he's sort of back in, largely the public's good graces now, and certainly things like Twitter, now X. And again, like him or not, this guy came in and basically fired 3 out of every 4 people at the company. And everybody was sort of grave dancing on, okay, this guy just made the worst mistake of his life, and this thing's going to be, shuttered in a matter of weeks. And who knows Twitter's long-term trajectory here, but by all general observable means, the company is still functioning, and Elon's posting charts of record monthly active users and stuff like that. So, it seems again like America is hoping again. And again, maybe it's that hope that maybe opens the trap door for all that fundamental data that I talked about to finally express itself. All right, well, look, so, well, I guess just before we close out this topic and go back to your book. So to my question, like, I know you follow the markets much more closely because they tend to be very confidence driven, but are you concerned about recession risk here, given the indicators that you look at?
Yeah, very much so. And I think we live in a market-to-market economy where the speed at which things in the market change impact the real economy too is faster than never before. I mean, we saw that with the war in Ukraine last summer, where crude oil prices moved into the prices at the pump in nanoseconds. And so I think we underestimate the impact of changes in the market on the real economy and the speed at which those move. And so I do think we are set up for a major slowdown, particularly because for the consumer, so much is unaffordable today if you are a pay-by-the-month buyer.
Which the vast majority of Americans are.
The vast majority of consumption today.
Yeah. Let me. So you're a behavioral economist. Let me speak to the economist side of you for a second. Speaking of speed, a timing topic that we've talked a lot about on this channel is the lag effect. Right, the Fed has hiked interest rates at a more aggressive pace in a shorter period of time than I think almost ever it has before. And I think one of the reasons why people were so confident there was going to be a recession in 2023 was because, well, surely those lag effects are going to finally arrive and really begin to weigh the economy down. And now there's a sentiment of like, well, they probably just didn't matter. This time's different. Fed pulled those levers, nothing materialized. I think we're going to be good from here. Do you expect the lag effect to actually manifest here, or is there something different about this particular cycle?
So I look at what we experienced in 2022 as a classic bullwhip effect. If we rewind to 2020, we cut supply, we cut orders, we cut inventory, we cut whatever we possibly could from the supply chain. At the same time, we gave consumers and businesses an enormous amount of cash.
Mhm.
We created the inflation problem that we then experienced. Classic supply demand mismatch. And so I think what we're seeing is an unwind of that. But the problem that I see is that demand is likely to continue to fall because of things being unaffordable. And so that affordability issue is going to now meet up with, I think, an overcapacity of a number of goods, from rental properties to cars, where we'll see real deflation in those items. At the same time, we're likely to see some level of inflation on the commodity front. So for the consumer, it's going to be a real mixed bag. And the question is, who will want all these rental properties that are likely to come on the scene? I'm terribly pessimistic about the travel space, which has a large impact on the rental world, given what we've done to Airbnb and VRBO the world.
Yeah, and it's interesting because
there's a lot of potential supply lurking.
Well, absolutely, and I'm not going to dig into that with you too much here, only because I've done it recently on this program with a lot of housing experts, so I'm right there with you. And it's interesting because if you look at the government jobs numbers, which remain incredibly robust versus what's gone on, with all the Fed hiking and tightening and whatnot. A lot of the growth in jobs is in the leisure and hospitality sector, right? So I'm gonna intuit then from your concerns that you think that won't be a big driver of job growth for too much longer, as the lag effect really begins to press upon the travel sector.
Yeah, I think that we are again at another junction in the travel space. This one being particularly interesting because so much of the profitability is tied up at the very front of the plane. And so I think that there's a lot of business strategy in hotels and airlines and in that industry overall that is counting on unlimited demand from the very high end as far as the eye can see. And so I think that the bubble that is unappreciated today is the one that's tied to the very top. All right, go ahead.
Let's talk about that for a minute, because, and sorry, I'm getting way further ahead of my list of questions here, but you keep making these great connections. So you talk about the K-shaped recovery, just to help folks understand what that is. And Peter, correct me if I explain this incorrectly, but it's basically like coming out of, we'll say the COVID crisis here is you're going to have the top of society do very well, and the vast majority of the bottom society, let's say the bottom 90% or so, are not going to be participating in the upside nearly to the extent of the top 10%, if at all. And examples of that have been, 90% of the financial wealth, the financial assets are owned by the top 10%. So as the markets have recovered, that hasn't really helped the bottom 90%. Bottom 90% until very, very recently has seen like years of monthly declines in real wages, right? So they've been getting left further and further behind, especially as cost of living has zoomed higher as it is here, right? So basically top 10% continuing to do great, bottom 10% continuing to get hammered. It seems that the economy, you can make an argument the economy will morph to really just mostly serving the affluent elite, right? We're going to increasingly become an economy that just caters to them, and everybody else is just hanging on by their fingernails and basically being a servant to the elite in this economy as a service worker. You're nodding a bit as I'm saying this, but this is your K-shaped recovery is your model here. Do you believe that we're kind of in danger of that happening as an economy? And if we are, and I just heard you talk about there maybe being a bubble in servicing the affluents, if they stumble, then the ripple effects of that will be pretty dramatic on everybody in the system, correct?
Yeah, I mean, if you travel into New York City today, I mean, it looks like one high-end shopping mall experience after another. And if it's not high-end retail, then it's high-end dining, it's high-end hotels. Everything is luxury boutique this or that. And what I don't think we appreciate is the dependence that municipalities, I take the train back and forth to New York, and I'm always stunned that the Acela, which is twice the price of the regional train, is full and the regional train is relatively empty. I don't think we've given much thought to how dependent the US economy is today on those at the top. You look at the prices of tickets to see Taylor Swift. That's not a good that can be bought by the average American. Broadway tickets. I mean, we've pushed prices
Sporting events, everything.
Yeah. And similarly, you have this fixation today among the extreme elite in sporting events, in team ownership. And that to me is another classic indicator of hubris.
So when you call it a bubble, tell me why you think it's a bubble. In other words, why can't this just keep continuing? And then what are the dangers to an economy and a society where wealth begins to get this concentrated at the top?
Well, why do I think it's unlikely to continue? It's statistics like, the most valuable company in Europe is LVMH. Okay, more valuable than Unilever, Shell. Choose your other European behemoths, and even more than that, that 4 of the top 10 are luxury good makers, and that's a huge statement on the confidence of those companies and those companies serve, and it's a very reflexive environment today. When you look at the buyers who are also the owners, who are also, it's a very tight web of circularity. So that, could it go higher? Sure. If policymakers around the world decide that the solution for everything is continued, asset price inflation, yeah, we could see high nominal asset prices that have relatively low real values because we choose to play the currency lever. But what troubles me is the complacency of those at the top and their general lack of appreciation for the malaise at the bottom. Mm-hmm. They believe that no matter what the outcome, they can leave, they can migrate to wherever they want to, that the crowd will allow them to exit gracefully. And history doesn't suggest that. And I think there is nothing like shared hopelessness to motivate a rapidly moving crowd.
All right. So look, this is not the conversation I was planning to have, but it's a fascinating one, and it's one I love to have the opportunity to have. So I'm glad we're here, Peter. A question that I have asked many times is, what's it going to take for the pitchforks and torches to come out? Right? There have been so many milestones sort of along this journey of the wealth continuing to concentrate, power and advantage continuing to concentrate in a smaller and smaller percentage of society in America. And of course, we can look at lots of other countries and see what it looks like, when this gets to the extreme, right? One of the things America has always prided itself on has been being relatively egalitarian. But we seem to be at a place where, at a time where, and I'm trying to remember who I talked to recently who said Schumpeter warned about this, where that capitalism might become too successful, where advantage begins to concentrate, and then those where the advantage is concentrating are reinvesting their resources in politics, in other areas, to be able to tilt the field increasingly to their advantage. And then you begin to get kind of like cartels that are running the system, right? And let's take the global financial crisis, right? It was created to a large extent by bad actors on Wall Street. And what happened in 2009? Wall Street managed to pay itself record bonuses that year, right? Like there doesn't seem to be much accountability. And despite all of that, nobody went to jail, right? Like there was no uprising of the populace. So how do you think this trend that we're worried about here gets reversed? Do we have to get to a Sri Lankan type of scenario where like just order breaks down to the point where people can't eat and they just show up at the presidential palace and literally drag the guy out? Or will we have mechanisms that allow us to maybe push for reforms before it gets that Lord of the Flies like?
Yeah, I mean, the ideal scenario to resolve this looks like higher taxation, a sort of an organized transfer of wealth and relative power from those at the top to those at the bottom. Whether our system can navigate that successfully, I don't know. I continue to worry about the prolonged feelings of underconfidence that exist and that sense of widespread hopelessness that only needs a spark. And I think to your point, we spend a lot of time acknowledging the stacked privileges that those at the top have today, the wealth, power, access. Choose the criteria, but appreciate, Adam, that when our confidence is low, those feel like stacked disadvantages to me, that somehow you benefited at my expense.
Mm-hmm.
And so for every one of those, there's almost a reclamation project that will need to take place, where it's not just wealth that is reclaimed, but voice and influence and control that migrates from this small group at the very top down to folks at the bottom. And here, I think it would be important to watch grassroots coalescence, as it were, because I think with this sort of an environment, it's likely to be spontaneous, localized actions that begin to coalesce into national action. And this, we saw this with the Arab Spring.
Okay, and I certainly the Arab Spring, I would say you could say we saw it with Black Lives Matter, right?
Yes.
I mean, it was individual protests in certain cities, and then it actually kind of morphed into this big national movement.
And I think Black Lives Matters is a good example of what happens when you have low confidence broadly, which was the backdrop to the spring of 2020. You have subsets that feel even more powerless and disadvantaged. And then all it takes is a spark. A single event, which may have occurred in the past, and in the case of Black Lives, had occurred repeatedly in the past. But the environment was ripe for that spontaneous response.
All right, interesting. So I just interviewed Neil Howe, famed demographer, Fourth Turning, about his new book titled "The Fourth Turning's Here." Like, hey, folks, we're in this thing now, right? And Neil echoes a lot of what you're saying, and sees kind of forced reform, sort of through social rebellion, if you will, or social movements, that he's equally concerned with us about the sort of wealth divide, and thinks that it will probably be in the bullseye of what the fourth turning disrupts. And we talked a little bit about the potential for political ideologies to shift here, and sort of asking about, like, to your point about sort of the shared hopelessness of the majority dispossessed, right? Like I get the appeal. I don't necessarily agree with the philosophy, but I get the appeal of like democratic socialism to this dispossessed majority, because it's this sense of look, I'm going to get screwed. I feel like we're getting screwed, and I kind of feel like I'm going to be screwed by whoever's in power. I may as well vote for the guy who's planning on giving me stuff versus the guy who's not, right? But to a certain extent, I think the hope too in a democratic socialist world is, yeah, there's going to be some wealth redistribution here, right? They're putting their finger on this pain point that I have, that the American dream, the brass ring, just feels unattainable to me, even though I'm doing everything right, because this coterie has all the prosperity locked up, right? So whether it's democratic socialism, whether it's some other political platform that achieves this, I do see personally, and you're much more experienced this than I, but I do see personally a higher risk of sort of redistributive policies coming out of DC, and that dispossessed majority like really championing it and wanting more of it. Now I worry that there's a very slippery slope, right, to saying, okay, things have gotten too out of whack, what can we do to try to rebalance it, versus, hey, we've now opened the door to just get stuff from people. And you create something that I think in many ways can be very undemocratic and very un-American, which is sort of the socialistic, let's make sure everybody has exactly the same, and then all the issues that come from that. So I'm curious, how do you see this potentially playing out here? So we have the social tinder for people to get angry about this. How do you actually see it potentially manifesting?
So there are a couple of dimensions. One, Adam, is that rather than the rich being targeted, it's a group we call shareholders, because shareholders today are this faceless, abstract they if you are a worker. And it becomes a very easy target to go after shareholders because nobody knows them. Mm-hmm. Nobody sees them in a real familiar way. And I think that's a very big vulnerability for corporations. And here I would add the other dimension of global corporations, which too are highly abstract. I can remember, I think it was during 2011, there was a minister in the UK who said it was okay to rob the big national global chains, but please don't rob the local stores.
Right. Yep.
And so that to me is an easy sentiment to share that I think would resonate, that we will go after this abstract global behemoth and try to protect our local whatever it is in exchange, not realizing that there are clear interconnections.
Right.
That those shareholders happen to also be your pension plan, happen to also be, but again, if I'm feeling vulnerable, I'm not giving any consideration to long-term implications. I'm looking for simple solutions that are highly emotional and impulsive. And here I think capitalism is especially vulnerable to crowd behavior today, given how abstract it is, how concentrated it is. It's got lots of strikes against it that it doesn't appreciate. And if it doesn't do something to help resolve this, what isn't given will be taken.
All right, and what isn't given will be taken. So how concerned are you about this? I mean, I think quite, but I want to try to put a finer beat on it. Like, Neil Howe basically says, look, you go through a fourth turning, and the job of the fourth turning is to dismantle the status quo. it has to break down, and then it's replaced by something that comes after, and then the seculum, which is the cycle of all four turnings, begins anew. Do you see it as inevitable as that like there will be, or you place an uncomfortably high probability on some sort of social, what do you want to call it, pushback, disruption? I'm trying not to use words like revolt or rebellion, but revolution, but maybe, I don't know. Are we almost sort of destined to have that, given how extreme the gap has become between the haves and the have-nots, and how low confidence in the overall system is amongst the mass dispossessed?
Yeah, and here I think the elders need to pay attention. We have magazine covers talking about the geriatric leadership that exists in the United States. And so if they're wise, they will work to have an orderly baton pass from one generation of leaders to another.
From one frail, bony hand to another.
But I mean, I don't believe, Adam, that the two candidates that have been identified are necessarily the two candidates that will be on the ballot in 2024. Mm-hmm. That if age becomes a rallying cry, we should expect to see much younger, more charismatic, more technologically adept communicators who inspire a new generation. I mean, it's hard to imagine this, but if you go back to the 1970s, Joe Biden was one of them in that moment of transfer. And now he has reached a maturity point where there needs to be a new transfer to a new generation. And I think the same should be said about on the Republican side. This is not a, one good, one bad. Again,
no, it's not. I mean, if you look at the leadership of both parties, but also just in Congress, I mean, it's a gerontocracy. I think the age has come down slightly with some of the recent transitions, but I think the average age was like above 80. If you added in like the 5 people in succession to the presidency, I mean, it was ridiculous. Yeah.
And remember that we also now have a term called hillionaire. So these are long-term people who have made an enormous amount of money from positions of power. And that, again, if I'm someone who is on the outside, that stings as well. They have money, they have voice, they have power, they have a lot of things that I do not have.
Okay, so I'm going to press you on this question one last time, and then we'll move on. But like, how inevitable might be the wrong word, but how likely do you think it is that we are going to have to go through some, let's call it, fairly substantial social transformation to get to the more equitable solution that we're hoping for, where this wealth gap is fairness is restored and the wealth gap is less extreme as it is now?
Yeah, I would frame it this way, Adam. We have to close the confidence gap. We have to close this gap between hopelessness and invulnerability that exists in the United States and also exists in other countries around the world today.
All right, so I'm right there with you, and I'm going to ask this question one last time, and I'm sorry to press, but you're such a big mind. I want to get your thoughts on this, which is, how confident are you we're going to close that gap elegantly, which I would say would not require some sort of massive social transformation?
I think the odds of that are I think the odds of that are very low, because those who feel invulnerable today do not appreciate their vulnerability.
Okay. Well, this has been, I think, really important and also just in general fascinating to me, and hopefully the viewers of this video. We have not talked too much about your new book. So in the remaining time we have, is there anything that you find very important about your book that we haven't talked about, you want to get on the table, or maybe germane to our discussion here, that you want to surface for viewers?
Yeah, so So when I talk about confidence, Adam, I'm really talking about the feelings of certainty and control that people have. And those feelings are so critical to the choices we make in all aspects of our lives. And today, why they matter so much is because the opposite of confidence is vulnerability.
Mm-hmm.
Rather than having certainty, I have uncertainty. Rather than having control, I feel powerless. And so if we want to anticipate how those at the low end of the economy are likely to behave, we need to think about them as feeling extremely vulnerable today. And with that come 5 natural responses. People, your audience will be familiar with 2 of them, which are fight and flight.
Mm-hmm.
You know, they are both ways that we take control of a situation. You know, we run away, we combat it. Third one is freeze, where we just become paralyzed by it. One that I think is woefully underappreciated is follow. And follow is actually our easiest response. We just get in line, which is why authoritarian figures become compelling. It's why cult leaders, predators, that this environment of underconfidence that I see is the preying ground for predators of all kinds. And remember, if we stand in the cold rain long enough, we will get in the car with somebody. And that's the risk that I think exists, that somebody comes along who provides a compelling reason to get behind them.
What a great way to say it. You stand in the cold rain long enough, we'll get in the car with anyone. Yeah.
Yeah. Yeah. And I think we forget that it's not, people worry about the depths of despair. It's like the longevity. I can hold my breath for a minute in, 60 feet of water, but I'm going to drown in an inch of water after 10 minutes. I mean, it's just, duration matters here. And there's a lot of people who've been underconfident for a long time. Last one, I call these the 5 Fs: fight, flight, freeze, follow. The last one is fuck it. And that is an important behavior that we should expect. This is an environment where you should anticipate terrorism, sabotage, things where people will destroy others because if I can't win, nor should you. So these are behaviors that naturally accompany the kind of mood environment we're in. And so why do I get so concerned about it? Is because I don't think those who are feeling invulnerable today have any appreciation for the speed at which those 5 Fs can spread and accelerate given today's backdrop of social media.
All right. And I know in your book, you sort of talk about once you understand kind of how confidence works, it begins to make the unpredictable more predictable here, right? So to your analogy there about standing in the cold rain and then being willing to get in the car potentially with somebody really who's very unsavory, but hey, if they're getting out of the cold rain after some period of time, you'll take that ride from anybody, right? So you can kind of look at the status of whoever you're studying the confidence of and say, hey, we're beginning to get down into that red threshold where they're going to start making some pretty extreme decisions here, right?
Yeah, absolutely. Yeah. And that was obvious to me, even before the Black Lives Matter moment in May of 2020, I was expecting social unrest in the midst of the COVID epidemic because the backdrop of mood was so low that all you had to do was to look at those populations that feel worst, and they're the ones who are most likely to respond.
Okay. God, I feel like we're just spending our time on the negative sides of confidence here, but it's so germane to where we are right now. So we can certainly point to certain populations and subgroups and say, hey, these people they're probably down at the fuck it level, right? They've got immense pressures on them. But if you look broadly, again, if you're back to your K-shaped recovery, if you're not in that 10% that's been enjoying a nice, recovery in your financial portfolio, you basically spent the past couple of years first, just suffering through all the psychological trauma of COVID and being locked down and, fear of dying and all that stuff. But then we came out of that to, raging inflation, cost of living's gone bananas, cost of debt has gone crazy, and we can see in the numbers that people are piling debt back on their credit cards and whatnot because they're having to just to stay afloat. That credit card debt is now, I think the average interest rate on it now is 22%, all-time record high. So it's not just a lot of debt, it's the most expensive debt that they've had. Housing market's gone crazy. It's only come down 1% nationally so far, so it really hasn't corrected that much. It's the absolute least affordable time in history in America to buy a house right now, given the combination of prices and mortgage rates. So, really we're at the point where, yeah, we've had some subgroups that have really been suffering, but now it seems like the vast bulk of society is beginning to descend below the waterline here and really beginning to feel the pain here, where, I think more and more people are just saying, I don't know how we're going to continue making it through going forward, given the fact that we're sinking. And then you add into here, which I don't think a ton of people think of proactively, but AI, right? Everyone's super excited about it, but potentially that could be a real job destroyer, right? And so we have an awful lot of factors that would make people who are just living their days feel less and less optimistic. And then if they're proactive and thinking out, maybe getting more and more nervous about what might be coming down the pipe for them. I guess where I'm going with this is it seems like if you think of this as the sinking of confidence as a rising and sort of just social pressure that could lead to some sort of explosion, it seems like that's what's going on right now. It seems like the pressure cooker is continuing to build here. Are you seeing it as similar as I am?
Yeah, I worry about chronic underconfidence today, Adam, that we eagerly accept the idea of overconfidence, where we overbelieve versus the reality that's ahead of us. Today, I feel like we are seeing the glass half empty at every turn. And the FDR quote, we have nothing to fear but fear itself, I think is spot on, because it is that fear that is likely the fear of what is ahead that is going to drive decision making today. But I think there are places to be optimistic in this. Okay, and that is to say, for those who will listen, there are going to be an enormous number of problems that are raised in all of this. And I talked to a bunch of people during COVID and said, just listen to where the problems are, because all of those will become opportunities. So in the case of COVID, it was about onshoring and what you could do to create just-in-time supply chains, or just-in-case supply chains. So right. Focus on redundancy and so as much as this environment of change can be viewed pessimistically, I encourage particularly young people, listen. We're going to vocalize a lot of things that are broken that need to be fixed. Each of those represents an opportunity if you have any kind of entrepreneurial spirit. How will you fix the problems that exist today? Because coming out of this, those will be opportunity. And I think of, Jack Bogle, who, in the early 1980s or, late 70s is looking listening to what the problem was that investors were feeling, from which we developed passive investing that carries the next cycle, cycle forward. I would listen. If you're an investment manager, listen to what breaks in this cycle, because what breaks will be the vulnerability that you want to address going forward. We never want to go back to what was, and so the solutions tend to be backwards looking in their foundation. The whole world of interest rate derivatives, to me, is a perfect example of something that came into existence because nobody wanted to experience those mismatches again.
Super interesting. Okay, so I can definitely see that, which is the people who are paying attention to really, what are the root causes of this lack, this loss of confidence. If you can create components that are part of the solution, you're going to do quite well. And I imagine that it also applies well to politics, right? That these, hopefully potential younger cohort of leaders that may emerge here, if they can say, hey, look, this is part of the sclerotic status quo right now that's just not serving us. Here's an idea I have that I'm going to run on, to change at least this one thing. Maybe that's how some of this stuff gets reformed over time.
Yeah, and I would just change the term root cause to story.
Okay.
Be careful, don't spend a whole lot of time trying to solve for the variables of what really was the cause. Cause doesn't matter. What is the story that we associate with the cause? Because that story is what is going to be compelling in terms of the problem that you've got to solve. I don't solve the problem, solve the story about the problem.
Interesting. And for the folks I know watching, are going to wonder, if you solve the story about the problem, does the problem then kind of take care of itself? Like, how does the problem actually get solved?
It does, because here's the situation. And I see this in crisis management a lot. Our crisis management tends to be focused on the problem. The plane that crashed, the fire that burned, the disaster.
Yeah.
But what matters in a crisis is the vulnerability we feel arising from it. So let's take Boeing with its planes. They had a mechanical problem, but the vulnerability was safety. We have to feel safe to get on the plane.
Mm-hmm.
So address the safety story. Address how do you make things feel safe at the same time you're solving the problem. But you can't put people on a plane where the problem is fixed if you haven't addressed the story about the problem.
Got it. Okay. If they don't feel safe, it's like the cat that jumps on a hot stove. It's not going to jump on a hot stove again, but it's not going to jump on a cold stove either. Just done with stoves, right? So yeah. You've got to fix the problem, but then more importantly to the consumer, fix the story. So they're like, okay, I trust the fact that the plane is safe now. Yeah.
Yeah. The difference between curing a patient and healing a patient is the elimination of the vulnerable feelings. I know that you are healed when your confidence is restored.
Okay, that's a
and
great
that's
way.
Different from being, the cancer has been cured, or you've got to eliminate that disconnect.
Okay, I'm going to try to start wrapping things up here, and I want to try to bring it, if I can, back to the markets. You shared at the beginning that you're kind of worried about these markets because they are showing, we'll say, while confidence has increased, obviously, since the October lows, it's sort of a narrow form of confidence. We talked about how you're not very confident, at least, in the macroeconomic landscape going forward. Do you have any sort of general advice for investors right now, given the kind of soup of conditions that we have in the markets right now? I'll leave it there. I want to ask another question, but I don't want to be leading to your answer. So I
do. I think that they need to be especially careful about their pie charts. That if you look at most investors, they have this beautifully multicolored pie chart of holdings. And if I go back to early 2021, what they missed was that every piece of that pie was piping hot. Bonds, stocks, real estate, you name it.
Yep.
When it came to sentiment, there was absolutely no diversification whatsoever. And they paid a huge price for that. And I think that when you're looking at whether you're diversified or not, you need to be thinking about it not in terms of historical correlation, but current sentiment. Do you own things that are burning hot and ice cold? Things where sentiment is rising versus sentiment falling? Because what's going to protect you isn't the mix of assets, but the mix of moods. And if you own one mood, which is what most investors do today, you're going to be brutalized in this balanced portfolio that you think you have. I mean, the 2022 was mean to everybody because they were not diversified at all when it came in terms of mood. You want to own things that you're not confident in, that you're extremely confident in. And if you don't, if everything in your pie is something that the market is extremely confident in, you're going to pay the price when sentiment turns in unison again.
That's super interesting. It's the whole sort of like, all correlations go to one in a bubble market when it starts bursting, right? So what you're sort of saying is sure, assemble your portfolio on the visible light spectrum, but then put on your infrared glasses and look at it. And if everything is burning brightly on the infrared, then you got to reassess because you're not truly diversified from a confidence standpoint, right?
No,
you want to see some things that are red hot, that are ice cold, right? Exactly.
Yeah. You want a mix of things that are people detest with things that are beloved, particularly today, because the relationship between stocks and bonds, it certainly broke down in 2022, and I think could easily break down again.
Okay. And I'm curious right now. So if we look at the markets, certainly AI stocks and just the Magnificent Seven piping hot, right? Bonds, less so, right? We've seen rates begin to creep back up here again, right? So maybe bonds are going to offer a little more counterbalance than they did, say, going into 2022. I'm just curious, are there any other assets either on the piping hot side or ice cold side right now that kind of have your attention?
So on the ice cold side, volatility, natural gas are two, and I am long both of them because natural gas became a huge symbol of the Ukraine war, and so was overbought at the top and has collapsed since then. And nobody, it's interesting that the people have gotten much more energized about oil than they have natural gas. Could be wrong, but I think the downside is very limited. And the same thing in terms of volatility today. I think that the Magnificent Seven being hot and being really, really hot means that your index funds are all piping hot too, whether you realize it or not. Yeah. That S&P 500 portfolio that you own today is an S&P 20, and given the weights and what's hot in those weights, you better count on those Magnificent Seven doing well.
So I'm really glad you brought that up because it's a topic I've talked about on this channel a fair amount, but I think it's probably still needs more people talking about it, which is how overowned those Magnificent Seven stocks are across the major indices and how much of a part of the market value of the indices those make. Meaning, if there is a loss of confidence in those stocks, it will disproportionately injure the main indices that the majority of investors are invested in. And in fact, almost any ETF, it's pretty hard to find an ETF out there that doesn't own Apple, right? I mean, it's just kind of everywhere, right? And with Apple specifically, they just had their earnings last week, and it was their third quarter in a row of year-over-year declines in revenue, right? And yet the stock is trading near a record PE for the stock. It's trading around 32 or 33 on a trailing 12-month basis. And kind of my question that I was putting out there is what happens to Apple when and if the market wakes up one day and says, you know what, I'm not sure this is a growth company anymore, right? It's got declining revenues. Does it really deserve a PE ratio this high? And of course, by asking what happens to Apple, you then have to ask, well, then what happens to all these indices and ETFs of which Apple makes up a tremendous share?
Yeah, I guess, Adam, my concerns are slightly different. These companies, this Magnificent Seven, traded as a block based on AI. Mm-hmm. So you have a common story, which suggests that if that story changes, that commonality is likely to move them down together in the same way that it moved them up together.
Yep.
The other thing I would say about these companies is this Magnificent Seven is a highly symbolic group. These are the American stallions, as it were. And so if they go, you're likely to hear stories about what's wrong with America. Mm-hmm. Has America stumbled? And so it becomes a bigger symbolic issue. And I would distinguish this, we can joke about Lordstown Motors collapsing, but if it was General Motors and Ford collapsing, well, then we take note that there's trouble in America. And so I think we need to recognize that this Magnificent Seven is trading as one and is a potentially broader symbol that could again have impact to our feelings of certainty and control more broadly.
Okay, and obviously the danger there is, let's use the reverse of my analogy of coming out of the doldrums at the beginning of the 80s and then feeling suddenly very confident about our future. Maybe it's sort of more the 1970s, as we just America just couldn't seem to get anything right? We had the inflation issue, and we got OPEC beating up on us, and then we had the hostage situation with Iran, and we just kept sort of having failure after failure, and we just began kind of giving up on ourselves for more or less than a decade.
Yeah, and I mean, we still talk about the bubble in stocks and the Nikkei, the Japan. We don't identify the names. It was sort of this collapse of Japan, and so to me, there's this potential to paint with a very, very wide brush that feeds into this malaise that already exists.
All right. Well, fascinating discussion, Peter. It's always wonderful when you're on the program. There's so many additional questions I'd like to ask you, but we're already well over our time, so we're just going to have you back on again. We did not spend as much time as I had planned really going through your book. So for folks that are interested in learning more about it, perhaps putting it on their own bookshelves, where should they go to get it? Just anywhere books are sold?
Yeah, anywhere books are sold. It provides the framework and the background to why I feel the way I feel. So, behind what may feel like rather dramatic views is a very logical, organized framework for understanding the impact of changes in confidence on the choices we and others make.
All right. And for Peter, for folks, in addition to getting your book, who have enjoyed this conversation with you and would like to follow you and your work going forward, where's the best place for them to do that?
So they can find me on X at Peter Atwater. I have a blog on LinkedIn. I have a website, peteratwater.com, where they can get more information for me if they're interested in my research or speaking, things like that.
All right, fantastic. And Peter, when we edit this, we'll put up the URL there so folks know exactly where to go. All right, well, Peter, thanks so much. And folks watching, Peter did a great job of painting with a very broad brush the uncertain future that we may have ahead of us here, both societally, economically, but also in the financial markets. And I just want to reiterate, as we always do on this channel, for most people, just average investors, navigating that solo without a lot of experience on understanding the psychological issues, the behavioral economics side of things that Peter does, as well as just the nuts and bolts of marshaling a portfolio through a volatile environment. Highly recommend that most people work under the guidance of a professional, seasoned financial advisor who understands all the issues that Peter and I have talked about here. If you've got a good one who's doing that for you, great. They're quite rare. Stick with them. But if you don't have one or would like a second opinion from one who does, consider scheduling a free consultation with the financial advisors that Wealthion endorses. To do that, just fill out the short form over at Wealthion.com. These free consultations are free. They don't cost you anything. No commitment to work with these guys. Just a public service they offer to help as many people position as prudently as possible. Peter, this has been wonderful. Really hope to have you back on the program here soon to continue the conversation if your schedule allows. Folks, if you'd like to see that, please vote your support for it by hitting the like button, then clicking on the red subscribe button below. And Peter, again, I can't thank you enough. I'll let you have the last word as we wrap up here with folks. Any parting bits of advice for them?
No, Adam, it's been a fun conversation. Thank you so much.
It's always wonderful when you're on here. Peter, thank you so much. Everyone else, thanks so much for watching.